It's nice to see some happy students, happy to be learning about accounting, bookkeeping. I thought I'd pop in for a moment and just say hello, but it's not about me, it's about you guys learning, so I will see you later. In this video, I'm going to do an exercise on asset disposal, and before I get going, let's just look at the transaction here, the information that's provided. Company A purchased land and buildings at a cost of 2 million rand in cash on the 1st of February 2004. Now what I have got here is I've got a timeline, and I have year 2004 and year 2005 because we're going to, according to the information that's given, do the transactions at the end of 2004 and at 2005. Let me read a little bit further. So the first thing we did was we purchased land and buildings in cash on the 1st of February in, let's call it year 1, year 2004. The cost of the building was 1.6 million. So they're giving us in the 2 million the price that was paid for land as well as the building. So they're giving a breakdown. So the land was actually 2 million less 1.6 million is 400,000. Now when we do depreciation, the depreciation will be on the building portion of the land and buildings. On the 1st of March 2005, in this second year that they've given information about, the building burnt down. On the 31st of May, 1.5 million was received from insurance. It says record in the general journal all the transactions for the year ending 31 December 2004 and 2005. Now this is slightly different to your normal asset disposal because what happened, there was a fire and the building that was worth or purchased for 1.6 million burnt down. And what happened was it was insured, and insurance, it says here, paid out 1.5 million. Now what I do is I draw up timeline as I have here, and I fill in all the bits of information. So on the 1st of February, there we go, we got land and buildings worth 2 million. Of that, a building was 1.6 million. So I'm filling in the information just so I get a clear picture of all this written information. The end of year 1 is December the 31st, 2x4. Let's make it 2024 as we go along. Then on the 1st of March 2005, the building burns down, and then they also give us information. Insurance pays out on the 31st of May 2025, and they pay out 1.5 million. Like I said, this is slightly different to a sale of a non-current asset. This year, a non-current asset, land and buildings, burns down, and insurance pays out 1.5 million in this case for the building that was burnt down. We're going to have to calculate on this whole event whether there was a profit or a loss on the burning down of the building. That's where we're going. And the end of the second year that we have information about is 2025, 31st of December. The first thing you need to do, they said, record the transactions at the 31st of December, the first year, and this transaction happened during the year on the 1st of February. 2 million was paid for land and buildings on the 1st of February in our first year. Land and buildings is an asset, a non-current asset. The land and buildings in our books has increased in value. An increase in assets, the rule says the account must get debited. So under the debit column, you have 2 million. This land and buildings was bought by using cash. Our bank balance has decreased. Bank is an asset. Decrease in assets, the rule says credit. And they asked us to record this transaction through the general journal. In the past, you might have done it through the cash book payments, but here they're asking for the general journal to be used, because I think they're checking which account here is debited and which account is credited. Then you write a little narration, and the narration is the purchase of land and buildings. Now remember, there was a split here, but we'll get onto that a little bit later. 400,000 was for land and 1.6 million was for the building. Now, what happens at year end says the 1st of February, the purchase of land and buildings was 2 million and the cost of the building was 1.6 million. And year end is at the 31st of December 2004. When did we purchase this? The 1st of February. Now what we need to do at year end is we need to depreciate on the 31st of December 2004 the cost of the building, which was 1.6 billion. Buildings are depreciated at 5% per annum on cost price on the straight line basis. Now the value of the buildings, I say it quite often, is 1.6 million because the other 400,000 of the 2 million was the land. What is depreciating? The buildings. Now this needs to go through the general journal. At year end of year one, depreciate the land and buildings that were bought on the 1st of February. There it says again, depreciate at the end of year one, which was, I say, 2024. I'm using that as an example. What account gets debited? Depreciation. And what account gets credited? Accumulated depreciation on land and buildings. So those are two new accounts. Depreciation is an expense, wear and tear on the buildings. An increase in expense, the rule says debit. So under the debit column, you've got 73,333, and I'll show you how that was calculated in a moment. The accumulated depreciation on land and buildings is a negative asset because it's going to decrease the book value of land and buildings, and land and buildings is an asset. So let's say accumulated depreciation on land and buildings is a decrease in assets, the value of the land and buildings. The rule says a decrease in assets, credit. And just There were cents involved here when you do the calculation, but it said round off to the nearest rand. And how the 73,333 was calculated was buildings, 1.6 million. They said it was 5%. And you have had this from the 1st of February until the 31st of December, which is 11 out of the 12 months of the year. So 1.6 million times by 5% times by 11 over 12 is 73,333. So now what you've done is you've recorded the purchase of land and buildings, and you've done depreciation on the buildings. And that was at the end of year 1. And they asked you to do this through the general journal. Let's move on. So there we go. A company purchased land and buildings. Now what happened on the 31st of May? The building burns down. Sorry, not on the 31st of May. That's when insurance paid out. The building burnt down on the 1st of March 2025. So now we need to have a look at what we do with this event. How do we record it in our books? And like I mentioned right at the beginning of this recording, we now treat this building that burnt down as if it were asset disposal. We need to, according to our asset disposal rules, it's normally depreciate up until date of sale. But what happened in this case is the building wasn't sold, it burnt down, and we're going to receive money from insurance. But we still need to depreciate up until the date of the burning. And we debit depreciation and we credit accumulated depreciation. And here the amount is 13,333. It was 33 cents as well, but I just rounded that off. Depreciation expense, increase in expense, debit. Accumulated depreciation on land and buildings makes your land and buildings worth less in the books. Decrease in assets, credit. How this was calculated was, we took the cost of the building, 1.6 million, times by 5%, because they said it was 5% on the straight line basis, times by 2 over 12. Because in this new year, only 2 months passed by until the building burnt down. So we depreciate up until the 1st of March, and in the new year, it was only 2 months. The previous year's depreciation has been done. Now we're in this current year. So we depreciate up until the date of the burning, or the date of the sale if we were selling this item. Now a question I ask you is, what is the cumulated depreciation for the useful life of the building? That means take in year 1 and year 2. And maybe you get the answer. It was 73,333, which was the depreciation for the first year. Now it's depreciation for the second year. 73,333 plus 13,333. So I'm just making you think to yourself, what is the accumulated depreciation up until the date of the burning? Because you're going to need that information to calculate whether there was a profit or loss on this event or transaction. So let's move on. We depreciated up until the date of the burning. Now we've got to transfer the cost price of the building to asset disposal. Now, hopefully you can see here with this black background, but you had land and buildings, and in land and buildings there was 2 million. There should be more notes, but you'll get the idea. There was 2 million. It says transfer the cost price of the building to asset disposal. The cost price of the building was 1.6 million. So land and buildings, this is the credit side, gets credited with 1.6 million. And we're taking this information to an account called asset disposal. So asset disposal is debited. An asset disposal account is an account to facilitate, just to show what happened, what was the net effect we need to record in our books of this building being burnt down. So we credited land and buildings to take out the value of the building that burnt down, and we transferred it to asset disposal, where we're going to calculate whether we made a profit or loss on the burning down of the building. So in asset disposal, you're going to have 1.6 million. Land and buildings now, if you balance this here, excuse me, would have a balance of 400,000, which was just the land. So we're transferring the cost price of the building that got burnt down to asset disposal. Now, what I mentioned earlier, we need to transfer the accumulated depreciation of the building to asset disposal. Now, once again, in the accumulated, this stands for accumulated depreciation. Don't get confused with asset disposal. I'll write in there DEP. Accumulated depreciation after year 1 and year 2 had a balance of 86,666. Remember, it was at 73,000 and the 13,000. They say step 2, transfer the accumulated depreciation to asset disposal on the asset that burnt down. So I debit asset disposal, I debit accumulated depreciation because I'm taking that amount to asset disposal with 86,666, and I credit asset disposal. And that was the transfer of accumulated depreciation year 1 and depreciation up until burning year 2, which is 86,666. I'll say that again. I transfer the accumulated depreciation balance of 86,666 by debiting accumulated depreciation, there it is, and I credit asset disposal. Debit and credit. That's the transfer of the accumulated depreciation. Now, what do I have in the asset disposal account? From the previous journal entry, I have the cost price, and now I have the accumulated depreciation in the asset disposal account. I just wrote this again. How did we get that 86,666 of accumulated depreciation? It was year 1 plus depreciation up until the date of the burning, which is 86,666. And both those two amounts would have been transferred to the accumulated depreciation account, and that was closed off to asset disposal, as per this journal entry in front of you. Now, I've taught this to you before in previous videos. The quick formula to calculate whether there's a profit or loss on the sale of an asset is you get the cost price of the non-current asset, the building, less the total accumulated depreciation for the useful life of the non-current asset. That, subtract that, cost price less accumulated depreciation, gives the book value. So in our books, this building, at the time it was burnt down, was worth 1,513,334. Now you will see we get an insurance payout for 1.5 million. It's worth more in our books than what we received, which results in a loss of 13,334. Now while we're here and I'm thinking about it, a loss is an expense. So basically this resulted in an increase in expense. This account here will get debited when we show it. Right, the loss would be debited. If it was a profit, it would actually be an increase in income and the account would be credited. Let's move on. So those are the numbers that we are working with in this example. Now, next step, record the sale. In this case here, it was an insurance payout, and they say we were paid out 1.5 million on the 31st of May. Now what I went and did was I recorded this in this journal here as May the 31st, because that's when we received the cash. Debit bank, credit, asset disposal. If they wanted you to do this and complete the asset disposal on the day that the building burnt down, we wouldn't have received the cash yet, and it would have been accounts receivable. Not a problem, because that's an asset as well. Bank is an asset, except what I've done here is I've gone and recorded as if we received the money, and I dated it when we did receive the money on May the 31st, and there we go. I've put in there, let me rub this out, bank, because when did we receive the money? On the 31st of May, 1.5 million. So I've done the asset disposal over a couple of months. I've recorded transactions that happened on the day of the burning, and I've recorded when we received the money on the 31st of May. So debit bank, increase in assets, and credit, asset disposal. Remember, the asset disposal account doesn't really have a category. It's there to show the disposal of the asset. Let's move on. So we recorded what insurance paid out, 1.5 million, and I forward dated this to when we got the money, May the 31st, debit bank, 1.5 million, credit, asset disposal, 1.5 million. Now record the loss. We've already calculated that we made a loss. We did that calculation and it was 13,334. I told you loss was an expense. Increase in expense, the rule says debit, 13,334. Remember, you rounding off, the question said round off to the nearest rand. So we rounded this off to 3,334. We actually rounded off along the way. So 13,334 debit, loss, general ledger account, loss and sale of asset, credit, asset disposal, 13,334. Yeah, I've picked up a mistake. A loss expense account is a nominal account, and the asset disposal is also a nominal account because it's closed off, and it will end up with, shall we say, a null balance because it's closed off to loss on sale of asset. Right, that was the loss on the insurance claim. Let's move on. Now what I've gone and done is all the transactions that relate to, in inverted commas, the asset disposal, I've put in the general journal, and I've said omit narrations, leave out the story. So there I debited asset disposal, I credited land and buildings. That was the transfer of the historical cost price of the building that burnt down. I depreciated up until the day that the building burnt down. I transferred the accumulated depreciation to asset disposal. That consisted there of 73 and this 13, which made it 86. What was the 73? The accumulated depreciation from year 1. This was depreciated up until date of sale from year 2. Add the two together, you get 86. Right, I've discussed that I think enough previously as we've moved through this video. Then we sold this asset. No, we didn't sell it. We received an insurance payout of 1.5 million, and we had calculated we had a loss on the building, and the loss on the building was 13,334. We closed off asset disposal to the loss on the building of 13,334. So this is the general journal, only to record the event of the building burning down and the insurance payout, in inverted commas, asset disposal. I wrote out this account, or typed it out, because I want to show you the asset disposal account. Let's say step 1, transfer the historical cost price of the building that burnt down, and it was 1.6 million. Step 2, transfer the total accumulated depreciation right up until the date of the burning, 86,666. 160,000 minus 86,666 will give you the book value in our books. It was sold for 1.5 million. Sorry, insurance paid us 1.5 million. That resulted in a loss when you guys did those workings. This amount here, another way to calculate this, if you didn't do the rough workings, is you check which side is bigger, and 1.6 million is bigger than 86,666 plus 150 or 1.5 million. To make the two sides equal, we credit asset disposal, then this account is closed off with 13,334, and we debit loss on the building of 13,334. So I thought I would show you the asset disposal account. This whole event resulted on our records a loss of 13,334, and the loss is an expense, and later on you will see that would have been closed off to an account called profit and loss. So there we go. That's an example of this building burning down and an insurance payout, and we treated this the same way as a sale of PPE, a sale of a non-current asset disposal. I hope that makes things nice and clear. You can watch this over and over. Chat to you soon. Cheers. Bye.